exactly what you have used at the end of the session.
Right now, several African countries have in the past year amended their value-added tax, VAT, or goods and sales tax, GST, and other indirect tax laws and regulations to tax the digital economy. Now, according to PwC's 2024 VAT Guide in Africa, a digital services publication launched today, the continent has no uniform or harmonized approach to taxing the digital economy. It observes that direct tax policies in different countries reflect significant variations and complexities in their definitions of services liable to tax and value thresholds.
The first thing that non-resident suppliers need to be aware of when supplying services to consumers in Africa is that the local VAT rules and regulations may not align to international best practices. For example, the majority of the countries around the world have a rule where a supply is made between two businesses across borders, then the person that receives the supply would account for the VAT under the reverse charge mechanism. But the majority of the African countries have enacted rules to tax non-residents in such a way that there's no distinction between services to an individual like me, B2C, or to a business, B2B. And this actually goes against all OECD guidelines. Another point to note is that most countries have very low VAT registration thresholds or even nil VAT registration thresholds. So whilst a non-resident may consider that their sales are not material, what they need to realize is that these rules will be caught in the local countries.
Now, the global